My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to save you some money. My job is not just to entertain, but to educate, put days like today into context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Goodbye, September. Goodbye, unhappiness. Yep, we had a very rough month, and keep with September's reputation as the worst month on average every year. But now it's coming to an end, and all I can say is good riddance after one more ugly session. Dow sinking to 500 points, S&P and NASDAQ both falling 1.51%. What went wrong? Put simply, the economy was just too darn hot. And unfortunately, it remains that way. Even though commodity inflation is now largely under control, we still haven't solved what I call the WFH burden. No, I'm not talking about that old pandemic salt work from home. Going forward, WFH on the Mad Money set will stand for wages, food, and housing, because those are the areas with the most persistent inflation. The Fed must tame these, and they have to do it by lowering the value of your house and your portfolio, while unfortunately putting your job in jeopardy. What a horrendous but necessary policy, as this kind of inflation will ruin everyone's purchasing power in the end if it remains unchecked. There are the three sticking points that we're dealing with as we go into October. The three key things that the Fed has not been able to get under control. Fed Chief Jay Powell hasn't stopped the wage spiral. There are just too few people in the workforce. A lot of people took early retirement. They have come back. He hasn't stopped food inflation, which actually comes down to bad weather and Russia's invasion of Ukraine, but it doesn't matter. And he hasn't stopped the runaway cost of housing, although I believe that is about to change with the new 7% mortgage rate. In September, WFH ran white hot. So the Fed decided enough is enough and hit us with our third straight triple rate hike. That's remarkable. That's the chief reason your portfolio got laid to waste and could continue to do so. So we have to ask, will the September nightmare continue? Well, there could be some respites, but I think the nightmare could continue. So let's start with our game plan for next week with that question in mind, because I do believe that the market can have spikes, but ultimately it's going to work its way lower for now, particularly the NASDAQ. Now, we have three events next week that will tell us if October is just an extension of September. First, we get the non-farm payroll report. That's that labor report that comes out. That's the most important thing, 12 of them, and they impact for the whole month, all right? I expect it to show too much hiring, remember, because it's backward-looking, and too much wage inflation, at least as far as the Fed's concerned. Remember, we are in a good news is bad news environment where we actually want to see and hear about more layoffs and lower wages, more firings, and I don't think we're going to get to that. There's just still too much business in this country. The other two events are speaking engagements by Cleveland Fed President Loretta Mester, okay, right before the open on Tuesday and then again on the close on Thursday. Now, you see, Mester's the primary inflation hawk on the Federal Open Market Committee. I call her the guardian of the galaxy because she is from Cleveland, where the Guardians play, and she wants to protect us, the whole galaxy, from high inflation, even if that means raising interest rates into a recession. And look, she said that explicitly. I'm not putting words in her mouth. I don't think that's prudent, but I understand what she's trying to do. Personally, I think actually raising interest rates into a recession is not prudent. I might even call it rash, because I think you can raise rates slowly to see what kind of damage they're doing after the tightenings we've just had. Tightenings, by the way, again, I agree with. But I'm not on the committee, and my views aren't representative. You got to understand, right now, it's Mester against your portfolio. And while she may not straight out say she wants your stocks to go lower, her hawkish statements certainly have that impact. The whole thing's self-fulfilling. Your portfolio goes down, your spending goes down, and the WFH situation, I said at the top of this piece, improves because there's less demand for everything. It's a terrible way to have it happen, but it's the only way they have. The good news is that Mester won't have the Labor Department's non-farm roll payroll report to use against us. The bad news is that I still expect to see a red-hot set of employment numbers, and she'll be strident in calling for multiple rate hikes in interviews soon after. She is the stalking horse for the Uber hawks. Right now, her view seems to be the dominant one, though. So how do you defend yourself against Mester and her harsh judgments, even when she ultimately may have your interests at heart? Own high-quality companies with good balance sheets and high dividends that will benefit from a decline in inflation, because that's what's going to happen. I'd like to be more inclusive, but I can't do that until the 2-year Treasury stabilizes at the 4.1 level, and it's not doing that. If it starts to creep toward 5% again, like it did today, by the way, in the afternoon, it started doing it again. If it starts doing that on Friday's labor report, well, then October is going to look a lot like September, and bonds will be a better deal than stocks. Now, there are a lot of very loud money managers these days who are making calls that we're about to have an awful recession, almost a cataclysmic one that could be worse, bad or as worse as the financial crisis of 2007, 2009. I call that the doomsday scenario. Now, I understand that anything can happen, but I think Armageddon does actually not lurk. Balance sheets are too strong, especially the banks. Last night, James Gorman, the CEO of Morgan Stanley, came on this show and laid out a more benign scenario where transitioning from too easy money to harder money, from profligacy to stringency. It can and will be painful. Neither of us denying that. It's going to be painful. We had a real good run, a lot of easy money, and now we got to pay the price. Gorman's looking for 4.44. This would be the optimal 4% unemployment, a tad higher from here to bring wages down, a 4% federal funds rate, a little higher than here, and a 4% inflation, which would cut the inflation rate in half. Yes, the Fed ideally wants to get to 2% inflation, but they may not be able to do so fast without needlessly wrecking the fabric of the country. If Gorman's vision comes true, we'll be able to put in a bottom maybe beginning next month. Too soon to tell if he's right, though. And if it doesn't come true, I think we'll have more of September. What else is going on next week? Well, Wednesday, we get numbers from two sleepers that I follow closely. Helen of Troy, the consumer packaged goods company that hit 52-week low, and Lamb Weston, that's the French fried potato company, just hit a couple of bucks, just a couple of bucks from its below its 52-week high. In this market, and I'm using these as examples, we saw this from Nike last night, all that happens is the downside gets accentuated and the upside just treads water or goes marginally higher. That's what I expect will happen with both when they report. Thursday, we get a report from the charitable trust situation that I like very much, but this market's treacherous. This is Constellation Brands, the company behind Modelo and Corona. I think the revenue numbers could be extraordinarily good. We just need to see if the water and glass shortages in Mexico have impacted the company's bottom line. ConAgra and McCormick report, too. The former hasn't done anything in ages. It does need to figure out a way to be able to grow its business. The latter already pre-announced a nasty set of numbers. And I got to tell you, again, when a company like McCormick pre-announced a negative number, the actual earnings just tend to reinforce the bad number. This thing's been in the penalty box for the past 3 to 6 months. I don't know. I think it's a great company. We also have an analyst meeting with Norwegian Cruise Line Holdings. This one's worth drilling down on because chief rival Carnival reported a terrible set of numbers this morning, and it crushed Norwegian along with the whole group. And people are liking travel and services. Well, maybe that's coming to an end. I'm betting Norwegian has better things to say than Carnival, but who knows? Carnival stock today was absolutely disconcerting. Finally, odd one, on Friday we hear from Tilray. That's the pot company, and I actually think they're going to be able to make a bold prediction about the legalization of cannabis. For the first time, I'm wondering if this could become, it's so low, with a very good spec play for the rest of the Biden administration. Look, I'm a stock guy. I'm not a Fed policymaker. But from here, I think patience is prudence, even as more rate hikes are inevitable. Let me give you the bottom line. The Fed raised and raised and raised right into a recession in 2007, and it destroyed the economy.
They know nothing!
They must stay tough now, but you can be prudent, rational, and tough all at the same time because they can't let what happened in 2007 happen all over again. Conrad in Connecticut. Conrad!
Booyah! What's going on, Jim?
How you doing, Conrad? What's happening?
I'm all right. Hey, 23 handle on Pinterest, and the talks of maybe they're going to sell if they got any sense. What do you think? Short-term trade, are you short or long?
No, I mean, I'm not. I just can't. These are expensive stocks. I don't have a catalyst to explain why it would go up. I'm going to have to say no to buying the stock. It's just, I mean, as far as I'm concerned, it's just too expensive. Joey in Missouri. Joey.
Hey, Jim, my call.
How you doing?
And thanks for all of your advice to all of novice investors here.
I'm trying. I got so many negatives. I feel awful, but I just got to stick by my guns. I don't want to hurt people. What's going on?
You're doing a great job. I appreciate it.
Thank you.
I would like you to know your recommendation on Roku.
I think Roku, Roku's still an $8 billion company, and it still sells. It's still losing money. So, therefore, I can't recommend it. I know I sound like a broken record, but my point is to help you. And that means saying no to companies that are losing money. How about Josh in Pennsylvania? Josh.
Jim, thanks for taking my call, buddy. Booyah.
Of course.
We're calling
Booyah.
about Kroger. Bought it a few months ago. Do you think I should hold it, or do you think I should buy something else?
I think Kroger is handling itself very well. I think they're doing a great job in private label. I think it's a super company. It's a very inexpensive company. It's got a good yield. It's the kind of company that I say you got to ride through, and you can indeed own. Okay, when you're trying to slow down the economy, you can put through some big rate hikes. That's okay. But then you got to let the country catch its breath before you do them again. Remember, the Fed raised right into recession in 2007 and destroyed the economy. They can continue to raise prudently, but they can't let what happened in 2007 happen again. Nothing. Oh, Mad Money tonight. After a tough week for the market, one stock was exhibiting peak performance. I'm taking a closer look at Vail Resorts and giving you my take. I'm trying to spotlight some good stocks here. Then, is it time to get bullish or buy? Well, is the VIX flashing warning signs? I'm going off the charts to find out. And in the face of volatility, it's always a good reminder to think about MI diversified when you're buying stocks, which of course is why we're going to play my favorite game, put your portfolio to the test. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.